Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is the podcast that will make you a smarter investor and, yes, a better leader. Before we get to our featured guest for today, have to start on our stock of the day. And really, this is a stock that is turning into the stock of the year, stock of the decade, stock of maybe even the century, except the company is not that old. That is Nvidia. Nvidia shares under pressure. Continues to see a sell-off, I would argue, since CEO Jensen Huang gave his keynote at CES. Some folks on the street wanted a guidance raise, didn't get that from Jensen, but now some new news here on Nvidia, firing back Nvidia. That is a new blog post today against the Biden administration, who slapped new restrictions on the shipment of AI chips. Before I get to that news, let me get to Nvidia. Nvidia is saying in this post, quote, in its last days in office, the Biden administration seeks to undermine America's leadership with a 200-plus page regulatory morass crafted in secret and without proper legislative review. So Nvidia coming out firing, and then the Biden administration with new restrictions on the export of U.S.-developed AI chips. There's three tiers to this new system that the Biden administration put out here, but it's the third tier that I think is getting a lot of this market focus. It's really focusing on the amount of computing power that could be bought by the rest of the world. That is what is being seen as potentially preventing China from buying computing power from other third countries. So that is something to watch. But ultimately, I think this issue brings to light at least three things on Nvidia. One, remember, Nvidia is now a global company, and with that comes more headline risk. This is not just a U.S. company. It's a company trying to put out AI chips to the world, so you have to keep that in mind. Also, risk with the incoming Trump administration. It is very likely the Trump administration keeps these rules in place that the Biden administration has put in, just given President Trump's focus on U.S. growth. And then last but not least, you have to keep in mind that growth for any company does not happen in a straight line. You will continue to see these fits and starts from Nvidia and many other chip players as they try to justify their valuation and get their products into the hands as many people as possible. All right, now on to our featured interview. Friend of the show, haven't talked to her in a long time, Gargi Chaudhuri, Chief Investment and Portfolio Strategist for the Americas at BlackRock. New title. I hope I got it right. Gargi, good to see you.
You did. Nice to be here.
Yeah, so I was reading your outlook for markets this year, but maybe we could start with what we're seeing today in markets. I mean, we're seeing, would you call it a tantrum? I mean, we have the yields 10-year hovering around 5%. This is now happening at the same time where energy prices are back on the rise. I mean, this is not what investors wanted to see to start the year.
Absolutely. So we'll start there because obviously that's come up a lot, not just last week, even though we had that big move both in the US and UK, but over the last 3 months since the Fed started cutting rates. And I think that's what's got a lot of people by surprise. So a couple of points to make there. Number one, why are yields moving higher? The majority of the reason, the big driver of that is stronger growth. And I think we have to remember that. So one of the big reasons that yields moved higher last week was that incredible non-farm payroll number with unemployment rate actually dropping despite participation going up again. So I think to the extent that yields move higher in a gradual manner, which is why I wouldn't quite characterize it as a tantrum quite yet, because we've sort of, yes, yields have moved higher, but in a more gradual manner than perhaps in 2013. And they do for the right reasons, which is underpinned by growth in the US and maybe even broader. I think that quality equities can still do okay. And I think that's a lot of what we focus on in our outlook that you just referred to. So yields going higher, good reasons for them because growth obviously has been stronger, and this acknowledgement that we might not get as many cuts from the Fed as we had originally thought coming into 2024.
Well, that's what we do in business news, Gargi. We look for words like it's tantrum, it's sell off, risk off. But isn't it weird only in markets that the bulls have to root against good growth numbers? I mean, jobs, theoretically, it's good to see the economy doing well, no?
Absolutely. I was actually, I will say, a bit surprised by the viciousness of the sell-off on Friday. That was unequivocally a very good number for the U.S. economy, for any of us who work in the U.S. Labor markets, which we all do. We want to see jobs created. We want to see wages rising.
We want a paycheck.
We want a paycheck. Yeah. We want that paycheck to be going up, but at a sustained manner, so the Fed doesn't have to raise rates aggressively or at all. And I think that's exactly what we saw. Now, what I'll also say is that coming into 2025, when you think back to the 57, I believe, all-time highs that we saw in 2024, when we think about, the pretty strong run that the equity market had in the month of November, especially, and throughout the year, but certainly coming into the end of the year, I think I would argue that a little bit of a pullback is healthy. It's even maybe overdue. You look at, I'm sure you guys look at this as well. You look at positioning. You look at the AAII Bulls and Bears Sentiment Survey. You saw a lot of that get quite stretched. And I think this is a healthy pullback. Yes, part of that is because rates are moving higher. And this is something that we write about in our outlook, that this is the time when you want to continue to focus on companies that have the strongest balance sheets. Just because all markets are rallying, we were never in the camp that you should be owning sort of those rate sensitive, maybe the smaller cap parts of the market. This is a quality play, and if markets continue to struggle a little bit in the near term, I think there's going to be a continued reach for safety.
That bull bear survey is so underrated. I really do. I love looking at that chart because it really captures sentiment in markets. But to that point, can these momentum names like a Tesla, Nvidia, AMD, all these names that drove the market last year, can they grind higher if yields are touching 5%?
There's nothing magical about 5%. I think it's a psychological number that we've, as market participants, that we've focused on. I think that if and when we get to 5%, and obviously we're talking about the 10-year here, because as we learned, the 20 and the 30 both touched 5% last week. If we do get there, at the same time as earnings growth continuing to surprise to the upside, as we saw for some of the larger names last year, I think they can continue to do well. These are, after all, very cash flow rich companies, and they're not as dependent on leverage as some other parts of the
Nvidia's not going anywhere.
Exactly.
They're just printing money at this point.
To the extent that, that there is more to the AI trade, to the extent that we're all using AI and there's sort of a broadening out of the AI trade, which has begun to some extent. And another really important point, to the extent that we're seeing now in 2025, expecting to see earnings growth, not just in the Mag 7 names, not just in those large 7 companies, but actually the 493 is expected to grow at a healthy 11% clip earnings growth as well. And of course, the Mag 7 are expected in 2025 Q1 to grow at about 18%. So that gap is narrowing, and I think that's a really welcome and healthy sign for investors to step out of cash.
And is this the year that you go out and buy those other 493 stocks? It feels like it's so long since we even really have we talk about them in the news, but I haven't really heard anyone say this is the year you try to find undervalued opportunities in those names.
In some areas. So we are talking about a certain parts of the market where we expect to see earnings growth, where the macro fundamentals underpin those sectors. One that we're talking about is actually financials, where again, if you look at earnings growth expectations, not just for Q4, which we're going to learn a lot about in just a couple of days, but also in Q1, that's in financials is where we're expecting to see some of the strongest earnings growth come through after tech and comm services, of course. That could be an area where investors continue to find returns like they did in 2024. But broadly, the theme that we're talking about in our year ahead outlook is one of quality. It is the intersection we call of quality and growth, with an eye on valuations, because obviously valuations are very important to investors, and we're talking about this concept of growth at a reasonable price, GARP. We're talking about looking at quality. We're talking about looking at particular areas of cyclicality, such as financials.
So how would you define a quality stock? When you're out there screening potential opportunities, right now in this environment, what makes a good quality stock that you would want your clients in?
Yeah, absolutely. So a couple of features of a good quality stock, and when we think about good quality stocks, we do look at QUAL, which is a ticker that represents our quality quality exposure. So we look at strong, healthy balance sheets. We look at low leverage, because that's really important in this higher for longer and higher for longer and longer environment. And we're looking at companies that are really able to have that earnings growth, that repetitive earnings growth. So all of those, the earnings growth, the cash flow, the leverage being lower, those are all what make a quality company and a quality stock. And listen, that can absolutely be in some of the larger areas of the market, that can be in tech and comm services, but there are also names in the healthcare sector, there are names in the financial sector that all have those quality characteristics. The other thing I will say, and we're already beginning to find this a little bit, is that when we look back to 2024 and even the first couple of days of 2025, we're beginning to see that there can be little micro narratives that take a hold of the market. So right now, the micro narrative is the one that we started talking about, which was this rate regime shift, this higher rate environment. That's the micro narrative. Maybe last week we saw a little bit about the tariffs come through with the Washington Post article, etc. These are little micro narratives that I think are going to be more and more prevalent in 2025. One of the ways that we think investors can actually take advantage of that is being a little bit more dynamic in their portfolio allocation.
So trading more? Or?
So looking at, well, if you have the ability to do so, absolutely, or looking at active management, and we're telling our investors to look at this dynamic factor rotation fund, which actually looks at the broader factors that are driving equity markets and rotates between them. And right now, obviously, our dynamic factor rotation fund is focused on momentum and focused on quality a little bit with some eye on value. But as the micro narratives or even the macro narratives shift, that can rotate on your behalf. And we think in 2025, that's going to be really important.
All right, hang with us, Gargi. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, having a deep chat on all things stocks and markets with Gargi Chaudhuri over at BlackRock. Good to see you again. I'm just really enjoying this conversation. I haven't seen you in a while. Is this the year, maybe we don't get any rate cuts?
There's certainly a lot of people that thought that as of Friday afternoon.
I thought we were getting 4 or 5. We come into this year. I remember talking about in December to some of my contacts. Yeah, we're going to have 4 or 5 rate cuts in 2025. Stocks are going to go up another 20%, and we're going to have another great year. Everybody gets big bonuses, and we can go shopping. But I don't know. The narrative has shifted really quick.
The narrative has shifted for good reason, though. I think the fact that the narrative has shifted because the economy is stronger, because the labor market is stronger. We'll find out about retail sales just in a couple of days. We certainly saw the ISM data. We're seeing vehicle sales data. All of that is pointing to a very strong start for 2025. And that's why the market's pulling back on additional cuts. And I think that's good for now. And I'll get to your question around how many rate cuts in just a second. But I do want to make the distinction between rate cuts getting priced out because of stronger growth backdrop versus rate cuts getting priced out in a so-so growth environment with much higher inflation. Thankfully, that is not where we are at the moment. The stagflation environment. That's not where we are at the moment. And there were periods of time, obviously, where Chair Powell got asked about the stagflation question. We'll remember that. There's neither a stag nor inflation answer that we got from him. We're not there right now, right? So inflation continues. We saw the PCE data at the end of 2024, a really a good positive momentum with PCE continuing to decelerate. We'll see what we get for CPI later this week. But as long as we're expecting rates to stay at these levels, actually probably a little bit lower than here, I think the Fed is very clear that they're at a pause right now. But maybe in March or June, is it likely that they can still cut 1 or 2 more times? I think so, based on the data at hand so far. Now, obviously, if inflation accelerates from here, or if the growth meaningfully continues to accelerate from here, it's going to be hard for the Fed to make a cut. But just listening to all of the Fed speakers from last week, obviously I know you paid a lot of attention to them as well, with Waller and Harker and Cook. Nobody was ruling out the possibilities of a cut ever again. I think the sentiment very much so was around, for now, it's a pause. Inflation's a little bit stronger, growth's a lot stronger. And let's see how this progresses. So I think 1 to 2 more rate cuts in this cycle, based on the data at hand, is fair to assume, with with a very open mindset. I think that's one of the things that 2024 taught me, at least, with an open mindset that when the data changes, we have to be very quick and adapt ourselves to the changing narrative. And remember, back in 2024, there was a time when we were thinking about March rate cuts and August emergency rate cuts. So a lot of shifting narratives, and I think this is going to be a similar environment this year as well. But higher for longer actually creates an immense opportunity for fixed income to clip coupon in fixed income in the front end and the belly of the curve. So there are opportunities even when the Fed might not go as many times as we had originally thought.
So Gargi, you're bringing up some really important points. I have to give a shout out to a prior episode we recently did with San Francisco Fed President Mary Daly, really reinforcing everything that you're saying here, Gargi. My interpretation was it is a pause. Need to see more data before they go out there and cut. Go find that episode on the Apple Music page, YouTube, wherever it is. It's there. It's really good listening. But you bring up an important point. Some of these potential policies by incoming President Trump, tariffs, tax cuts, to me they seem inflationary. How do you read it?
So I think we just don't know enough yet. I think anyone that's sitting here and telling you that they have it exactly modeled out. In fact, even the Fed told us that, they told us that it's not a part of their model, and then they told us maybe some people are considering it as a part of their inputs. But even the Fed has told us that they themselves haven't necessarily figured out what they mean. But one of the things that we highlight in our year ahead outlook is this environment which requires very specific, very bespoke hedging strategies in your portfolio. So even now, when we're seeing a little volatility in the equity markets, instead of rotating away into cash, why not add some hedges? So if you're afraid about the implications of tariffs, or if you're concerned around the implications of higher rates on your equity portfolio or even on your fixed income portfolio, why not think about hedging or adding some hedges in certain parts of the market? For example, one of the things we talk about is with respect to whether that be immigration, whether that be tariffs. If there is, and we don't know yet, but if there is a short-term or even a medium-term inflation impact, real rates are really attractively priced right now, right? With the big backup in interest rates that we have seen, break-evens or inflation expectations have only about moved 20 basis points or so since September. So real rates, as a result of that, have moved significantly higher. So perhaps adding some real rates in your portfolio, and we talk about sort of STIP, which is looking at the front end of the inflation-linked bond market, that's a good hedge.
Do you do that now, or wait until you
I think,
see some of these strategies?
Again, thinking about hedges, you add the hedges when, you don't add the hedge in your portfolio when the fire is already lit. Yeah. You sort of add the insurance risk before, this is probably not a great joke, but you probably add the hedges before the eventuality takes place. So I absolutely, and also because right now, real rates are very attractive. So I wouldn't say this if real rates were sitting at, 1% or even negative, which is what we've seen in the past. But above 2, between 2 and 2.5% real rates and sort of the 5-year part of the curve, we think that's a great opportunity for investors. We're also telling investors, think about a few other things. For example, continuous rise in deficits. That's obviously something that comes up again and again from clients.
Our entire lives, every day on this planet, everybody's now talking about deficits. But my typical question is when I hear that, is this a year that markets will care? Who knows?
Who knows? We don't know. We don't know. 2023, we had a period of time where the market cared and then the market didn't. In 2025, that may happen. And some people are certainly calling this recent rise in yields related to, sort of the bond vigilante in the market, et cetera. Maybe, we don't know. I would say there's a good part of it related to growth as well. But if that's a concern, should you be thinking about other assets? We talk a little bit about adding gold and Bitcoin as one of, again, sizing appropriately. Absolutely important when you're looking at a very volatile asset class. Sizing matters very much so. And our BlackRock Investment Institute actually just wrote a paper about this exact thing, about how sizing cryptocurrencies appropriately matter. And again, if you're concerned around rising deficits, could that be an appropriate hedge?
Is that a 5% holding in your portfolio or not even that much?
No, actually, the paper that I was referring to earlier is actually talking about closer to about maybe a 1%.
Okay.
And if you do add that, what that might do to a 60-40 portfolio. So a small, and again, I want to be very careful. Certainly, this is not for everyone. And certainly, this is a very volatile asset class. But even if you look at just obviously, we all know cryptocurrencies have done very well in 2024. But even if you look at a week like last week, where bond yields were up, equity markets were down, so you didn't get that traditional hedge from bonds. But what was it? What did give you a little bit of a diversification actually was Bitcoin and gold. Those two things didn't. Obviously, we're talking about 1 week, but I think recognizing that some of these assets can have other diversifying uses in a portfolio, I think is important. And again, when markets get trickier, adding hedges, especially when growth is still good, is what we would recommend clients to do.
Where do you fall in that debate? Is Bitcoin like gold? Do you need to have, I guess, own both of them in your portfolio?
I would say that there is a place for both. What we have found is, obviously gold, we have a longer history, and especially in geopolitical stress environments, gold has been a really good store of value for centuries, right? So, and we have that available for us. And I think you can own both, and I think we're increasingly seeing, obviously IBIT is something that we launched in 2024. It's going to be about a year this week, and we've seen over 50 billion in flows. So investors who own gold and those who don't are looking at this as something different, whether that be rising deficit concerns, whether that be geopolitical risk concerns, whether that is just diversification away from the US dollar concerns. They're looking for that hedge, and more clients are asking us about it. So having that as a tool in your toolkit, we think, again, sized appropriately, makes a lot of sense. And I would also say, sticking along that hedging theme, I think this is also another time to think about, are there ways in which you can immunize your portfolio from sort of equity beta? So we have a lot of actively managed market neutral strategies. Our Tactical Opportunities Fund, for example, is a great one where you're not taking a lot of that beta risk. So if the market's moving up, you're not moving up alongside it, but using the tools that many of the active managers have in their toolkit to be able to generate alpha without taking directional bets. I think those are the things that investors could and should be doing in their portfolio as a way of immunizing against some of these currently rate shocks, but other micro shocks.
In the last minute and a half of the podcast, we always love to get hot takes from our guests. You and I were talking off camera. Yahoo Finance has a big birthday, 28 years old, January 17th, 1997. Do you remember when the platform launched?
I do. We were talking about this earlier. So I was in college. I was just new to the United States, and I had a car. And one of my earliest Yahoo Finance memories is Yahoo Maps. Yeah. Printing out Yahoo Maps and driving to visit my sister in Chicago from Ohio.
That's cool. My memory was in 2000, my last year of high school, Yahoo Finance had like a stocks game, and you were able to buy 5 stocks, and we got a grade on it. I had no clue what I was doing.
What'd you get?
One of them, I actually vividly remember this, Global Crossing. It was a typical like .com boom stock. Now I only know that 20 years later, but that's like in the moment, I just went like, this. I had no idea what I was doing. I had no clue. But now look at us. Like we're like pros. We're like market pros. Well, it's good to see you, Gargi. I appreciate it. It feels like I got a whole market lesson in this limited time. We appreciate it. It's really good to see you.
It was wonderful to be here. Thank you.
Gargi Chaudhuri over at BlackRock, really friend of the show. Really enjoyed this episode. Be sure to give us those thumbs up. I think thumbs up are on YouTube. Yes, it is. Likes on Apple Music and Spotify. We appreciate the support. We try to answer all your comments, so keep the comments and the feedback coming. That's how we get better, and we continue to bring you amazing content. That's it for the latest episode of Opening Bid.